What is going on, ladies and gentlemen? Today we're going to be talking about the short butterfly. Now, I already got a video on the long butterfly, so if you don't know what that is, check that out first, because if you understand what a butterfly is, this video will make a lot more sense. But essentially all a short butterfly is you're buying the two middle contracts and you're selling the two outside contracts, or the wings. Now, if you don't know what I'm talking about, you should really go check out the other video, because I feel like it'll help you understand the butterfly a lot better, and you'll understand what I mean by buying the two middle contracts and then selling the wings. But I'll just give you a visual representation of what the short butterfly looks like, and just kind of give you some strategies to use and why it would be useful. So let's check it out. So just like the last video, I'm going to do it on a stock that doesn't have that big of a spread, so it's easy to explain and show. So we're just going to do the SPY again. So to make the short butterfly, you would buy two of the middle contracts. You would buy two of these 334s, and technically this would be the at the money contract, and then you would sell one out of the money contract, and you would sell one in the money contract. And you can do this anywhere on the chain. We're just going to do it like this as an example. So we got to customize the order, go to the one we bought, add two of them, and now we would receive a total credit of $14, assuming we get filled at $14. Now when you review the order, you'll see that there's a $100 collateral, and that price comes from the difference between the strike prices. So the two contracts you bought, the 334s, and then the one you sold, the 335, and this one, because this is $100 away from the 334 as well. It's just below it, so that would be your range of where you could lose. But on a long butterfly, you want to get in the contract. You want to be as close to 334 as possible. But for the short butterfly, in order to get this $14 credit, by February 7th, SPY would have to be below 333 or above 335. And if it was in between 335 or 333, every cent from 335 is where we would start losing money. But you also have to factor in your break even, which in this case, you have $14 credit. So you would do 335 minus 14 and 333 plus 14. So it'd be 333.14 on the bottom side of the butterfly, and then it would be 334.86 on the top part of the butterfly. So if SPY ended at 334.86 on expiration, the February 7th, we would make no money and we would lose no money, because we would just have to pay back the $14. But anywhere in between that, the closer it gets to 334 from our break even, that's when we're going to start losing money, and we're going to have to slowly be paying this collateral. So if it ends at 334 on the dot on February 7th, we're going to have to pay this $100 collateral minus our credit, so that's going to be $86, and that's really our risk in this play. But the best part about this is it's really in our favor. It's really only a 14% chance that the SPY is actually going to end in between these contracts. So you have a really good chance of getting this credit. It's just very minimal for the risk you're taking. But if you just want to make, $5, $10 here and there, these plays might be really good, because you might be able to get one farther away from the money. And on a stock like the SPY that doesn't move like insane, the SPY maybe only moves like $3-4 a day, you have a very good chance of your contracts expiring worthless. So that's really nice. One thing I don't think I mentioned in the last video is that you can get assigned on butterflies, and on a short butterfly that really doesn't affect you, because you would just exercise the contracts or whatever and you would still have your $14. But on Robinhood, you have to pay a $20 exercise fee, so you want to take that into consideration. If you have a chance to get exercised on these contracts on Robinhood, it's really not beneficial, because yeah, you're getting this $14 credit, but you're going to have to exercise two contracts, so you always want to be aware of that. And you don't want to get anything like too crazy in the money, because you do not want to pay $20 to exercise this butterfly when you're only getting $14 of credit. Let's do one a little farther out of the money on the put side, see what kind of credit we would get. Let's buy two of these 329s, sell a 333, and sell a 328. Put two in there. We would get $5 credit on that, which is really not good at all, because we would have a $100 collateral. That'd be a $95 risk just to collect $5. But if you really don't think SPY is going to end at 329, then this is a pretty decent butterfly. Make sure you don't get too far in the money on these, because you do not want to get assigned on these. On other brokers, it's really not a big deal, because a lot of them don't charge exercise fees, but you do not want to pay a $20 exercise fee on Robinhood. That is actually ridiculous. I don't even understand why they have $20 exercise fees. That's just like insane to me. But in order to get this $5, just like the call contract, your butterfly would have to end outside of 330 or 328. The closer it gets to 329, the more of this collateral you have to pay. So if it ends right at 329, you have to pay $100 collateral minus your credit, so $95 total, and your break even is 328 plus the credit you got, and 330 minus the credit you got, so 329.95 and 328.05. So if it ended at either of those numbers, you would make $0 and lose $0. I just really want you guys to be careful on these butterflies, because I don't think I mentioned this in the long butterfly video that you can get assigned on these contracts. I just don't want you guys to be giving $5-10 to your broker and then having to pay a $20 exercise fee. That's just ridiculous. I just want you guys to be really careful with that, because they can assign your contracts even if it's like $1 in the money. It's really just something you don't want to happen, especially if you're only getting $5 credit. If it's like a $100-200 play, yeah, maybe it's not as big of a deal, but on these butterflies, you don't want to get assigned. So yeah, I hope that makes you guys understand what a short butterfly is. Just know that you have to end outside of this contract, and then that's how you get your full credit and not pay the collateral. You buy 2 of the middle contracts and then you sell the outside ones. But just be really careful with these butterfly strategies. They're just really risky. Yeah, it's only a 5% chance that it'll actually hit and you'll have to pay the $95 in collateral, but that's just a lot of risk to put on the table, even for a 5% chance of you losing, because you still have an opportunity to lose. So you just got to be really careful with these butterflies. But I hope you guys enjoyed this video. If you have any questions, leave them in the comments below. Be sure to leave a like on the video. Be sure to subscribe to the channel. Be sure to check us out live. We're live Monday through Friday, market open to market close. And I'll see you guys in the next video.